Next session is going
All right. Fight for a seat there, Felipe. Yeah.
Gotta say hi to the Dutch speak.
There must be a security checkpoint.
you can say whatever you want.
Yeah. Oh, we're being live streamed.
As long as somebody has one here. Could be an interesting session. Don't worry. So please take your seats. Yeah, whatever. So did you really?
A lifesaver.
Coffee is one of the wines.
It's even a little bit cold.
You can drum up some audience members.
Should I? Do you have someone here?
Yeah.
You got this one.
Thanks, Chris.
Thank you. Life force.
Good to go? It's broadcasting. All right. Well, good afternoon, everyone. Thank you for joining us here in the Digital Innovation Pavilion, as well as for those of you that are tuning in online via YouTube. My name is David Greenall. I am with KPMG International. I am also the chair of the board of Novosphere, which is a not-for-profit that has the pleasure of hosting the secretariat for the Climate Change Coalition, which is the sponsor and host of this pavilion, of this session here today, led by Miroslav in the audience, as well as other key individuals, such as Tom Bauman, who's not able to be with us today, but many thanks to him for his efforts in setting up the Climate Change Coalition. Really excited to have this conversation today with all of my fellow panelists. We're talking about a topic that has been discussed ad nauseum, I'd say, over the course of COP so far, around the topic of carbon markets. But the angle that we're going to take today in looking at carbon markets, we're going to look at a particular dimension with respect to the intersection of digital technologies as well as insurance, and how both individually and in combination they may be able to address some of the fundamental challenges that face carbon markets today. We have three panelists. I'll ask, as each of them speaks, I'll ask each of them to introduce themselves quickly as they provide their responses. But just to start to kind of set the stage, I talked about, we're talking about carbon markets today. I think, it's well recognized that carbon markets represent one of the best potential instruments or mechanisms that are available to us to scale global climate finance. At the same time, over the last year or so, there have been significant challenges, what I would frame as effectively a crisis of trust, particularly within the voluntary carbon market. Lots of reasons for that, and we'll dig into that with our panelists. And I think that crisis of trust has really, led to market instability, I think a lot of pressure on price, on supply and demand. But I also think coming out of it, there's a very clear expectation in the on the part of buyers that they're looking for carbon credits that are of high integrity. Now, you can define high integrity in different ways, but I think effectively what that means is that they are looking for proof. They're looking for proof of impact in terms of the emissions or the removal impact of the projects that they're investing in. I think fundamental to addressing issues around trust are methods that are employed by various participants within the carbon markets life cycle in terms of applying measurement, reporting, and verification methods. Historically, those methods have been primarily manual in nature. But I think overall, the course of the last number of years, we've also seen the emergence of digital technologies and what we can just sum as digital MRV that are trying to get at some of the issues that characterize manual-based processes around inefficiencies or efficiency or inefficiencies around the ability to scale and fundamentally their ability to address transparency considerations. And I think on top of that, we've also seen some other emerging developments within the carbon market space to address some of these questions around confidence and trust. One of those being the emergence of insurance and risk protection instruments and products. Earlier this year, World Bank, MEGA, came out with a program to offer insurance cover with respect to carbon credits relating to political risk. But clearly, there are all kinds of different dimensions of risk that are associated with carbon projects and their ability to deliver those kind of impacts in terms of emissions that buyers are effectively looking for. And in response to that, in addition to the World Bank, we've seen the entrance of established large institutional insurers, reinsurers, brokers into that space, as well as a range of startups that are addressing various components of that risk continuum. So all of these issues, I think, is what we're going to dig into and try and unpack and understand both what's going on today within the market and also maybe read the tea leaves a little bit and get a sense as to where things may be going. Okay. So with that, I'll go back to one of the kind of the starting point for all of this is around the issue of trust and confidence in the carbon markets. And I alluded to some of the challenges around that. Maybe here I'll ask Toby if you can kind of dig into that a little bit more. Give us a sense as to what you see as being some of the principal issues with respect to trust and confidence, what kind of impact that's actually had in terms of both the supply and demand side of the market, and where do you see digital MRV kind of fitting into this mix around addressing confidence?
Thanks, David, and thanks for the invite to this panel. So trust, yeah, it's been a rough year for, I'd say, the voluntary carbon market. There's been a lot of attacks on integrity in the press, and a lot of them ideologically anti-market driven, but nonetheless pointing out, issues that need to be addressed. And that's been one dimension that I think has sort of caught the attention of a lot of buyers and corporates that are worried about what they're buying and potential risks around the assets that they have in their portfolios. And then that has been compounded by the greenwashing attacks that the corporates have been facing, and litigation and regulations around claims and the underlying assets that support those. So those two things together have really, I think, had quite a chilling effect on demand in the voluntary carbon market this year. And that has translated through to supply in the sense that the project developers, there's obviously a lot of contracts in place that can still continue through, but in terms of new contracts or renegotiate contracts, there's a lot of pressure now on the projects to find new buyers, new sources of finance, or start up new projects is challenging. So I think that's definitely had a big impact on the market. And in parallel, of course, all the different actors in the space have been taking major steps to address the different issues around integrity, transparency, and claims. From Vera's side, in particular on natural climate solutions, we've been working really hard for the last 2 years to basically come up with a step change in terms of how RED, reduced emissions from deforestation and forest degradation projects, are accounted for, in particular around baselines, which has been one of the most contentious areas as to date, has been very challenging to establish in a transparent, consistent way with the project methods that are currently used, which were best practice in their time when they were set up a decade ago by all the leading scientists, practitioners, and NGOs. But in the last couple of years, there is now a recognition that we need to standardize more in a kind of top-down way in terms of how you allocate baselines and how you calculate some of the emission reductions from RED projects. So we have a new methodology from the VCS, the Verified Carbon Standard, that was released last week. And that takes a top-down allocation approach, working with government reference levels and baselines allocated down through risk maps to the projects. And that has been very well received. We've been working on that for the last 2 years. There was a lot of data work that went into that. So working with the leading scientists and other technology companies to basically come up with market grade deforestation data, jurisdiction by jurisdiction, which didn't exist. And so that work is halfway through, and the first allocations and risk maps will be developed at the beginning of next year, so projects can start using the new methods. So that will go a long way to address some of the core integrity questions that have been raised around, certainly around RED+. And then to pivot to your, well, did you want to cover the digital stuff, or should we pass off and come back to the digital side of things?
Give us your overarching perspective, and then we'll...
Okay, on digital.
Yep.
So yeah, so digital has huge potential, and we at Vera have been embracing that for the last, I'd say, a couple of years as well, and basically digitalizing all of our methodologies, all the tools, all the project documents and templates, and that work started in earnest at the beginning of this year. We're probably 2/3 of the way through, and by the middle of next year, all of our methodologies will be digitalized. All the new meths will be digital native. All our project documents, templates, tools, they're all digital, and so we're piloting that, and then that'll be required in the first half of next year. So basically all the inputs will be digitalized. They'll have cross-validation checks from all the different forms and tools that relate. That's been an error or an area of error in the past. And so we'll be able to run validation checks electronically on all the materials, take away a lot of the human errors that we've seen in the past. And then we are... we have an initiative, a dMRV, digital monitoring, reporting, and verification pilots with about 8 different sectors. So we have RED, afforestation, blue carbon, soil carbon, micromobility, energy, industrial. And those are working with the leading partners in each of those sectors that are developing dMRV platforms that then will dock into the VCS standard and allow that data to be pulled in directly into the monitoring reports and used to potentially automate all the way through to verification. And that'll be a huge value, both in terms of transparency, all the data being made available and transparently reported. Secondly, in terms of consistency, we're seeing a lot of inconsistency with human inputs and checking. And then finally, it will really increase the speed and efficiency of the system to the point where we can actually start to do automated verifications and potentially order of magnitude faster and more frequently than is currently happening. So that's an exciting area of innovation that is going to be live, fully live next year.
Excellent. And I'll just pick up on some of the words that I heard you say there. So you talked in terms of dMRV. I heard the word speed, efficiency, addressing some of the common errors that you were seeing popping up, and effectively allowing end-to-end verification and validation of these projects and their mitigations. Maybe you can switch over to David. And David, if you could bring that to life a little bit, talk about the work that you're doing with your company, bring your experience into it, and talk about, what does this actually look like in practice? Like, how does it work? How does your technology work? And give us a sense, if you can give us a sense as to thinking about the entire life cycle, right, of a credit, everything from origination all the way to issuance and potentially also retirement. Where does digital fit into that mix?
Well, digital fits into every single part of it. It's probably better to give a little bit of context about why I joined Context Labs and what Context Labs is. For the last 25 years, I've been a professional trader on Wall Street. And over the last few years, I've been monitoring closely and looking at what's going on in the carbon space. And it reminds me of a lot of markets that I've seen developing, that I've been part of developing in the last 25 years. And the issue at the center of it that I could see was really just information, data, transparency, but of the highest quality that you could find. So I kind of went out and had a look around to see what is out there in the marketplace in terms of the standards of who's good at data and who's bad at data, and it's a very broad spectrum, right? So anyway, my path led me up to Cambridge, Massachusetts, and I met the CEO, Dan Harple. He's developed a lot of technology over a few decades, and the technology is absolutely, I think, in my biased opinion, sort of the definitive solution to digital MRV. The digital approach to what's gone on with Dan is it's 7 years of development at MIT, and it's the intersection of everything you can imagine that we need today, which is obviously AI, machine learning. But when you really get down to it, I've seen this many times in my lifetime, but and the scale of the solution we need has to be, to the definitive word, true enterprise scale, right? So the platform is built, obviously blockchain, but massive scale is not an issue. So by way of example, we've started out the business. There's three areas that we're covering. One is energy. The other is obviously built environment, and then nature, right? But the energy silo is where we decided to start out and apply a digital MRV to that. And so the biggest gas producer in the US is on our platform, which is EQT. And, we're digitally twinning all of the assets in real time. And then that allows us on the MRV, and I believe there should be a Q on the end of it, being quality. But the measurement, obviously, once you know how to handle very, very complex data from all sources. So the approach for Context Labs is that there is absolutely no way that a single sensor or any method is going to be telling you the absolute truth as to what's going on. So to devise the ground truth, the approach at Context Labs is to take all and everything. So be it human, be it satellite, be it drone, be whatever it is, a sensor that is, and that space in itself is the important thing with Context Labs as well. Is the design of the platform was to never be wed or married to any form of technology that is monitoring or measurement, because the space there is moving so rapidly. You can't, it's literally something new every single day. So from our perspective, it's literally the digital is best in class in terms of the enterprise fabric, everything that is coming off of the back in terms of really, really high quality analytics to look at what is going on with the manual data that's going into it, right? So the system's able to filter out when there's errors that are either from even a sensor itself or from the human. But it's literally a triangulation of everything simultaneously. So it's ground, air, whatever it is that is constantly triangulated. But for us, in order to really move the bar on quality, so when you're talking about measurement, it's really, the question becomes about cadence, right? So how often are you doing this, right? And so really the belief that we're doing in the work to get to higher quality is to improve the frequency of measurement, right? So anything that gets us to that point where it's ultimately in the nanosecond, or obviously daily, whatever it has to be, but certainly not annual, right? And certainly not quarterly. So a lot is going on in terms of what we're doing as we sort of progress towards nature, is making sure that the system is able to source the best things to improve that cadence of measurement. But on our system, what we have in terms of reporting is, once you've obviously got a data set that is perfected, two things occur. One is obviously you're able to do tremendous analytics on what's actually going on. But then we're doing something that is incredibly important, whether it be a project or an asset, is that we're actually truly contextualizing the data, right? Which is, if you've ever tried to contextualize data, it's incredibly difficult to do and do well. And that is really, I think, the secret sauce behind what we're doing with the data. And once you actually have filtered through everything, we've got a mechanism that obviously immediately prints a credit, and the life cycle of a credit, as you ask, is it's not very complicated, right? I mean, the credit is issued when it's actually validated that a metric ton has been removed from the atmosphere in the case of nature. And then obviously, what we're working on, what I'm working on, is really taking that and being able to access it to the marketplace, right? And really, I think the issue on our side is two-part, is bringing in obviously the buy side of the market as well. So, and we're hoping that through much higher quality of what we're doing, that sort of answers itself through time.
Yeah. Excellent. And I think picking up on what I heard from you, you talked about clearly the benefits of the technology and what it allows you to do. But I also heard it's not about just the technology, right? It's not about removing the human element as part of it, right? So it's kind of all-encompassing and taking the right element of it, but also recognizing the ways in which technology can help to address some of those efficiency, right? Some of those scalability challenges that kind of traditional or more manual-based processes had some limitations around. Stephanie, I wanted to turn to you. So thinking about the other part of what we're talking about here. So we've talked about, where digital comes into the mix and how it may help to address some of these, data quality, data integrity, scalability issues. But I go back to my opening comment that fundamentally, I think a lot of the challenges that are being experienced right now, relate to confidence on the part of buyers, trust in whatever they are purchasing, right? So they're skittish for whatever reasons, and there are a lot of reasons around that. But there clearly are risks in terms of delivery. And I think to what I said, kind of starting at the starting point, is that we've seen some increasing demand for what I'll call kind of traditional products coming out of the insurance space that may help to address some of these issues. So I'll turn it over to you. What I'm hoping you can do is give us a sense as to how you see that intersect with insurance, where you see this market going in terms of, and I think both the insurance, but also the ability of the developer of the projects themselves to actually be able to absorb any costs that may have and complexities that go along with that, right? So very interested to hear your thoughts on that.
Thank you. Thanks, David. Thank you again for your invitation. So I'm Stephanie Betts. I'm with Aon Climate Team, and I'm heading Alliance Coalitions and Reporting for Climate. So obviously this is a topic that is very dear to our heart, because we totally believe that solving the current crisis, or confident crisis, if you want, that the market is going through, is essential to help us solve some of the most critical issues we're facing. So the first thing I would say is we're in the business of risk. And this is a risk that is escalating everywhere. So by definition, our job is to help with mitigating risk or transferring risk. But the next step is we can't really help on risk unless we have data, actual data. So for us to design products, we need actual data that we can trust and we can rely upon to assess and price the risk. Then obviously we spread the risk to make sure that it is a viable proposition overall. So coming back to the quality of the data, that's essential. And we believe that the emerging technology that we're seeing now and the advance that is literally almost on a daily basis now, the breakthroughs that are coming through are going to be critical. So the first one would be temporal. I think if you're going to look at an asset and only check on the asset once a year, so many things can happen. Someone's hungry, needs to feed their family. It's going to, get some trees. And so having near real-time data is critical. And I think that's going to unlock a lot of possibilities. Then it's the granularity of the data. Now, we're seeing a lot of companies launching into satellite data. It seems like everybody and their brothers are doing satellite data. And that's great. But I think the key point is the analytics. The key points are the insights, is how you manage that data and how you embed all the different sources that you take from ground, whatever you call ground truth or semi-truth, because harvested by human, prone to errors, sensors with the odd mistake, satellite data, and any other data, including historical data, if you can, to really create a set of insights that are actionable. So that's really the key. So I think the digital transformation that we're seeing is going to bring a level of transparency that we haven't seen before. And I think that's going to be very positive for the market. The other thing that we're seeing that is going to accelerate the move towards carbon credit is going to be regulation. So this is where the regulator is our friend in trying to solve the problems we're facing. And we have CBAM coming in Europe. We have CSRD. Europe is very prolific at the moment. We have TNFD. And all of that will drive companies to really take a hard look at where they are, crossing over with natural capital, what their externalities are, and what they need to address or offset. So that is going to be a massive driver. So companies aren't going to be able to get out of it. And we as insurers have to get ahead of that. And this is why you've seen a raft of innovation in the market of people trying to help their clients, anticipate that. So I'll maybe speak briefly about the sort of innovation that we've been involved in this year. So we're working hard on looking at how we could address the problem by offering insurance, because if people can buy credit and they've got insurance, that if there's a problem with that credit, they'll be covered one way or another, whether the asset is being regenerated by someone else or whatever, but they'll be covered, especially with the regulator and with incoming fines. I think that will certainly spur huge growth in the market. But there's an aspect I'd like to mention, which we don't talk a lot when we talk about carbon or resilience credit, as I'd like to call them, is the fact that sometimes we focus very much about the interest of the buyer for his offset and his own safety, legal safety and reputational safety, and also the producer. But what we don't look at is the incentives of the people at the base of that. So the easiest one is land use, and looking at whether it's agriculture, whether it's forestry. The people who are the guardians of the ecosystem, we depend on them for the quality of those assets, right? First of all, yes, we need the monitoring real time if possible. But secondly, I think if we can imagine a system whereby they were incentivized to look after those assets better, and same thing for people doing more technical stuff, right? If they were properly incentivized to look after those assets, I think we'd get a much better quality of credits overall, because everybody would win. And I think we need to look at these things in a more systemic way, and then build a system that works for all. And then I think we'll have, plus additional transparency, I think we'll have something that really flies. So that's really how we look at it. And at the moment, we're looking at helping farmers for the moment across the African landscape. And we have the ability to monitor on a daily basis 1 meter square to see exactly what they're doing. But I think the cleverness of the offering is not just that we'll give them free insurance to build resilience so they can keep looking after the assets rather than walk away and do something else. It's also sharing some of those insights, some of the big data we have on climate, on pest infestations, on things coming their way that are going to challenge the performance of the asset so they can take action. And I think, again, this is going to build the robustness of the market from the base. So that's really talking about natural assets, whether it's coral, mangrove, or ag or forestry. But I think we can embed similar principles and similar setups across the value chain. So it's really thinking more systemically about what is really working for the people who are looking after the actual asset, first of all. You had another question for me, and I can't remember what it is now. I forgot.
Just your sense as to kind of where you see the future of insurability.
Oh yeah. Oh, it's going to be enormous. So right now, I have to say that, of course, but it's true. So right now, what we're seeing is we have existing products that are really straightforward. Political risk. We've done that forever. Aon spends 200 million a year on data. We work with a lot of very famous academics, but we work with a lot of companies that are giving us data and intelligence. So that's really what we do. And therefore, this is a market that is perfect for us because we can help our clients also manage their risk better, take better decisions. So I think in the landscape where your climate risk is escalating daily, these companies are going to need that insurance in order to move forward. And whether it's at the early stage of a project or whether it's just further down the line at the, sort of offsetting level. So I really think this is going to be a really thriving market. I think that the lull we're seeing right now in the market is temporary because there's a little of things are a little bit vague at the moment because we're in between regulations, right? TNFD is not mandatory yet. But when it becomes mandatory, things are going to start to heat up. When the SEC gets up the curve and it stops fighting with the Supreme Court, we're going to see some big move. And if people are managing to sell products outside of Europe and the US, maybe they can manage without carbon credit and without insurance, but there's not many of those in terms of very big companies. And then again, very big companies employ smaller SMEs to work for them. So I think this is going to be everywhere. And this is probably one of the fastest moving segment of the market that I would anticipate for the next, few years.
Just to add something on what you said, Stephanie, with TNFD and top-down regulations, for the voluntary carbon market, the equivalent really of that we think will be very helpful in terms of the integrity questions right now is the ICVCM, the Integrity Council for Voluntary Carbon Markets. And they have these core carbon principles that basically standards bodies, methodologies can apply to be approved under. And that will create like a baseline of quality across all the standards, the methodologies, different activities. And that will make it more accessible and easier for corporate buyers and others to, delve into this space with a bit more confidence and more consistency, or just knowing that their portfolio meets a minimum benchmark of quality.
The other aspect that's going to, I think, help the current carbon market is it's been very focused on tech, on sort of carbon capture, of course, forestry. But I think that everything to do with land use and coastal resilience is about to come to the market. So once we finally cracked, and there's a couple of consultations open, I think Australia is one of them, interestingly. New Zealand also has opened a consultation on a new framework for these sort of they're not really biodiversity credits, but whatever we'll call them, whether they're resilience credits or carbon credits as well, because it's all carbon at the end of the day. I think that will also really help because they will need a framework there. And I think there's going to be an opportunity for what we currently think of as carbon credits and those credits to come together to have a common framework. And I think that's going to be really important for the market. That's really going to spur the growth. This is at least what we're hoping.
Yeah, thanks for those comments. Maybe I can offer a kind of counterpoint argument, and I'd be interested to hear your thoughts. And Toby, picking up on the core carbon principles and the CCP labeled credits and what that may do in terms of kind of imbuing a higher degree of confidence in the market around what's out there in terms of high integrity, high impact credits. Given that we've heard about the benefits of insurance, we've heard about the benefits of digital and dMRV. Each of those comes with a cost, right? Financial cost, and digital, pretty new for many of the developers, right? They may not be familiar with it. Clearly, there's a learning curve, or there's an adoption curve and cost that goes with that. Many of them may not have insurance or insurance covers to the extent that they may need it. What are your thoughts? We've heard about where the drivers, what's gonna trigger them to get to the point where they're going to say, I've got to take this on. I've got to build this into my project economics. Right.
It's very straightforward, this one. Thank you. I think that there's always a curve. You start innovation, it's expensive. And as soon as you get up the curve, it becomes a lot more affordable. There's also a lot of opportunities, I'm sure, to price differently for bigger companies and smaller companies, have dynamic pricing, because ultimately we want this to work, don't we? It has to work. And the other thing to think about is companies will need to future-proof their businesses. They can't afford to sit and wait. And the large companies have enormous budgets set aside for transition. So we need to also consider how that's going to play out. So when you look at some of the big, in particular, food manufacturing company, they'll have hundreds of, some of them have billions put aside just for transition until 2030. That's a lot of money. That can absorb insurance and tech. And the tech is salvation for them because they have enormous issues in terms of supply chain. So when you have volatility, I'm going to take cocoa as a good example. If suddenly you have your cocoa growers deciding to stop doing cocoa farming because it's not viable, because there's too many pest infestation, they have too many problems really producing and getting paid or getting indemnity on time when there's a problem, because actually most of the time they have no insurance anyway. So it's a really, really a strategic issue for these companies, because as this fits through the chain, so the value chain, you end up losing market share, losing shelf space. It's very expensive for them to not deal with that problem. So there's a lot of attention right now being put on potatoes, apparently lots of issues on potatoes, coffee, cocoa, and we're starting to see that stress into the supply chains. And it starts with price hike on the commodity, but then those who look further out realize that these companies are projected to be selling X amount of chocolate in 3 or 4 or 5 years by the analysts in the city, but they might not be able to produce it. That cocoa won't be there. And I think when this realization starts to filter through, this is going to hit the share price, and that is going to be a lot more expensive than technology or insurance. So I think they've got to move now.
Yeah, maybe just to add, I wouldn't assume in terms of carbon standards that technologies won't be embraced in their own, on their own without, or that they make so much sense in so many areas. It's just a question of, can they be developed and operationalized through the standards framework? So if we take dMRV, the current methods, as David said, in terms of it's so slow, and has all sorts of errors, not transparent. And so what we're seeing in terms of project proponents and buyers is they're chomping at the bit to be able to use the new technologies. They just want it to be operational. And the other thing we can do as a standards body is, rather than pushing that work onto individual project developer by project developer, is actually link our standards to these platforms, these dMRV platforms, and it'll be open source so that you can have competing platforms out there, but then each project proponent doesn't have to develop the technologies and the approach themselves. They can just pay their fee, and that's going to be so much more efficient and cost effective right out of the gate than what we're seeing with current methods. I mean, for example, a red baseline for reduced emissions from deforestation or afforestation and reforestation projects, the amount of time and money it costs to do those things up to a standard grade is massive. I mean, for a single project, it's tens of thousands, if not hundreds of thousands of dollars sometimes for complicated projects. So we think actually the economics make perfect sense. And then just one other point about the standardization. We're also launching next year a long-term monitoring system. So the current approach with, for example, the ICVCM in terms of long-term monitoring is, in their core carbon principles, they require that projects monitor for 40 plus years, basically beyond 40, their any losses. So if you're conserving a forest, planting trees, you have to monitor the project area, and if there are any losses, you have to report them and compensate. But what we're doing is actually taking that over ourselves at Vera to make it more efficient and standardized so that the project proponents don't have to do it, and there's more integrity and transparency because you're not expecting the interested party to do that. So we're working to build, well, we've already built it, but it's going to be operational next year, which is basically pulling all the data sources from the visible satellite data, as well as radar and LiDAR. And basically we'll first identify losses in any of the project portfolios and flag that to us. So the projects have to remedy that. And then secondly, it will calculate the actual carbon loss, so the carbon stocks, using LiDAR or other technologies that can quantify the carbon stocks. And then finally, using models to figure out, we'll start to use that data as for prediction so that we can start to get a handle on or start to fine tune our standards and methodologies so that we're actually getting ahead of risks and thinking about that from the standard side. Then, of course, you've got the insurance and all the rest to layer on top of that.
Comments on
Well, yeah, I got a few things just noodling in the brain. But, being a professional trader for the last quarter of 100 years, I'm sitting here thinking about, like where we might be as a matter of example of like where we're sitting. And it's, imagine tomorrow that I told you that, we're working, Microsoft is one of our partners. So I've used Microsoft as the example. Microsoft comes to me and says, David, here's $50 billion. And we're going to create the same as a bond market. We're going to have an issuance, and the issuance is going to go out, or call it a tender or whatever it is. Tender is going to go out. These are going to go out in $1 billion clips. We need to scale this market. Here's the issue. We want Vera. It's going to be insured because of our data quality. And that's the issue. The MRV has to be done and the analytics has to be done by our platform because they trust what we're doing, right? So the combination of all three. So I see in the future these channels, much like the formation of the bond market, right? Where we need to scale, we need capital. We certainly can see where the capital comes from and know how to tap into it. But it's this issuance approach that I think that we're going to address and want to be able to sort of combine all three together to say, look, we can scale this, and it's a combination of best in class across this, but then create that mechanism to create reverse issuances. So it could be a project that I know 3 projects right now that are tremendous projects. They just cannot get funding, right? So with an issuance process that we're working on, I think it's going to address a lot of matters to sort of say, the insurer is going to say, we like what you do. We like their methodologies. They're best in class. Let's go with this. And let's just put money to work and fix the problem, right? Which is not sort of siloing off, but working together. So, but I think, we've got a lot of like announcements across, what's going on in the next year that I think the market is going to come together around and really support and move forward in leaps and bounds. But, I think this moment in time that you referred earlier to, sort of the down moment here, I think, we'll look back in a couple of years' time and laugh it off, hopefully.
I agree that open source is a really important element of the solution, and because that's going to help scale all of these solutions across the board and also make them more familiar with people. And I think that then you add that trust and that transparency. That's all the market wants. I'm not a trader, but I'm an ex-broker. So I'll tell the truth. Yeah. And it's the same. You need fungibility. You need instant. You make it easy. Investors like things that are easy and that they can report upon easily. They don't like complexity. It needs to be straightforward. So they're not, they're not project managers. We need to do all of this for them. So we need to collectively get together, find good assets, ensure there's total transparency on those assets. If we can get in near time, imagine if you have a monitoring. These are all because that's what we're doing at the moment on the ag front. We'll have a platform we can monitor every day, almost on a near continuous basis, what's happening at 1 meter square. Done. Everybody knows what's going on when it's happening. And I think that will solve the enormous, that's stuff, the major hurdle to adoption.
So, yeah, I think we were talking before about the cost, right? So who wants to pay for this cost? And I think, at the moment, everyone focuses on the project developer, which you're obviously seeing a lot, Toby, right? But it really, the approach I've taken recently is going to, a couple of very large corporate buyers and sort of saying, look, hey, I just saw you pay $500 a ton for a direct air capture, right? So, but, for a project that has massive, carbon social value associated with it in a particular country in Africa, you're not willing to pay more than $25 or whatever it is. And to me, that's absurd, right? And so, we're basically turning it around and saying this shouldn't be something that's borne by the project developer. This should be something that the buyer is demanding, and the transparency on what it takes in these different building blocks, or Lego blocks as I call them. This is a Lego block. We're a Lego block. Be clear, if you want to make this scalable and do it right, there is a cost. Let's make it transparent. It's not a profit center, and let's just move, right? And that's what we're trying to do is enable that.
The other thing I would add to that is insights. So I know they can get a bad rap, but I love insets because the inset will be so much easier to sell to the corporates. You'll say we've mapped out your supply chain because that's 90% or between 75 and 90% of your externalities. We know where the hot points are. Why don't we help you find projects that really address your problems in your supply chain? So then when you actually sell that to your board, sell that to your stakeholders, it's something that's relevant to you. So much easier to report to the regulator as well, because one, you understand the problem, therefore you'll understand the project and the solutions, you'll be able to put some real weight behind it. And then you clean up your supply chain at the same time. So it's double benefit. So why do you want to buy offset that are far away, removed from your business model, from what you do? Do something that has some connection, some connectivity with what you already do and where your externalities are, and try to unpack those externalities with a good project and transparency. I think that for me would be the ultimate goal.
So just picking up on that, and I completely agree with that perspective. Just a question in terms of, so you're having that conversation, you're trying to shift that mindset. How's that going? Are they receptive to it?
Yeah, I don't think there's any concern at the moment with people, wanting to pay. I guess it comes down to a couple of things. So I wish we were a little bit more transparent in the SBTIs. Is every corporation should have an internal price of carbon, right? That internal price of carbon is critical, right? So if you're talking to someone like Meta or whatever, $60 a ton, right? $60 a ton, but I go to them and say, look, to improve the quality of the measurement and reporting and de-risk any misrepresentation as to what's going on, with what we're doing, the transparent cost is going to be whatever, say $3 a ton or whatever it is the absolute number. If the number is going to be twice what it is today, that's problematic. Right, so that's where it gets to what you're talking about, like direct air capture going from $800 a ton, people believe, to 100. I don't know if I'd ever see 100, but maybe 200. But so it's the same thing, right? So there is a bit of a leap at the moment to sort of say, if you're looking at an $18 credit and the stack on the tech to do it right is 10 or 15. It's certainly hard, but it's really just trying to get it down to that fine balance of what moves. Yeah, exactly. What do we need to be at to get it to that? So we're playing with that dial right now, and it's a critical dial that we're trying to dial into those buyers to basically say, we will actually commit to this. And I actually had an interesting conversation the other day about this and what we're doing. And another corporate name that's worth mentioning, because they walked away from this market, is Neste. And then when we sat down talking about this, and they're willing to come back to the table on it. So yeah, I think it is. They just want that transparency. They want to be able to see it. And as long as it's not a hidden cost, I don't think that, or too big a component cost, then it's okay.
Okay. Well, we have about 10 minutes left. Are there any questions from the audience?
I'm not going to be stand up. I'm going to be here. Okay. So it's a pleasure to be here. I was listening very carefully, everybody. And here, I would like to put a question for all of you. So, in the journey for the future until 2050, I think probably we are going to see a market, especially on the carbon, that is going to evolve on several regulatory new challenges, new issues. So how do you see that pathway between the voluntary carbon markets, the NDCs, the regulated carbon market, and the future 6.2, 6.4 on that process, and the evolution of the compliance all along that journey, and how that will impact the standards, the data, and the insurance? How do you see that?
So that's like my favorite. We were just talking about this actually before, so I'm kind of like giddy happy you asked that question. So what we're really, when you look at the complexity of the market, the voluntary market and the compliance market, this is so unique to anything else. Like if you go out and say there's a different segments of the gold market or whatever. It doesn't exist like this, where you have this regulated and non-regulated, bifurcation. So the secret, really, in my mind, to solving the carbon problem and going forward, every single day that I see another regulatory market for carbon enacted, I just get excited, right? What I look for in it is the size of the bridging between what is allowed to cross those bridges. So be it the carb market, be it Singapore, be it Australia, whatever it is. But those bridges to me are critical in terms of what their allowance is for, the ITMO, whatever it is, to come from the voluntary and is accepted by the regulatory market. And those bridges, I think, are absolutely paramount, and everyone needs to be hyper focused on those. And I think that what has to happen behind the data is a couple of things to cross those bridges, is for us as an organization on the voluntary side to say, look at the quality of this data, look at how this is insured. Now you have to understand, these people manage tail risk for a living, right? So if they come in with their methods and sign off on something, it really matters, the same way as KPM signing off on an audit, right? It matters. So for me, we're going to be going over the next few years as part of our business to really push hard and push all of us to work together to enhance the size of those bridges, which I think will increase the buy, increase the confidence, solves a lot of matters. So that's what I see.
I think that's a brilliant point. Thank you. I was taking furious notes. But the other thing is, I think regulation, if you see what's happened to climate regulation, it started with an alphabet soup and everybody said, I can't do this, too complicated. Okay, we couldn't possibly start. And actually over time, you've seen convergence and everybody wants the same thing. And at some point, if the regulator is serious about this and is serious about climate, they'll have to converge. There is no way out. So I think this is the bet that we can make, that things will converge the same way regulation on climate has converged and regulation on nature will have to converge because it's everywhere. And you can't have different, you might have adaptations to allow for local situations, but that's it. We're going to see a high degree of convergence. So those bridges that David's talking about is exactly that. It's those first areas of convergence that is like it happens to converge. But soon I think it's going to be something that's going to be driven by the regulator because they have to.
Yeah, no, it's a great question, Ludovina. Thank you. And just to build on what was said, there's linkages, or there's good examples of those linkages already and convergence, right? So you have places like Colombia and South Africa coming online, Chile, Singapore, that basically already accept, for example, in those places, VCS credits to meet tax or compliance obligations. And it's a great way for governments to get jumpstart, have immediate supply and actions on the ground, and they can set the activities in their own countries, for example, like Colombia. And then in the cases like Singapore, where actually for Article 6.2, they're going to use voluntary standards to actually meet that objective. And I think that, source credits from other countries. And I think it allows, for one, it allows innovation in the VCM. So you can actually cover new sectors, new approaches that maybe regulations would take more time or be more cautious about. You can prove them, and then either they just stay linked or they become regulated, and that moves into the mainstream, and then the VCM moves to the next area of innovation. So I think it's very complementary and allows us to move further and faster with more sectors in climate action than would otherwise be possible if you had the two siloed areas working together.
Thank you. Any other questions?
Cheers. Thank you for the panel. And my question goes to you, Toby, is we see a lot of innovation, right, with startups or new companies building platforms and methodologies, approaches to increasing transparency and quality of carbon. How does Verra expect to work with those new players? What's the expectation around standardization principles or the metrics we use to qualify carbon? Oh, I'm sorry. I'm the Carbon Finance Co-Lead of the CFAR Alliance. We're a coalition of digital financial service providers that are figuring out what the role or the entry point to climate action is. new innovators that are developing new methodologies or platforms, tools, MRV that are their own methodologies, and so there's some overlap, maybe some innovation. And so how do you expect to work with, or what would be the best way forward to work with these innovators?
Great, thanks. Yeah, it's a great question. I mean, from Ver's side and the Verified Carbon Standard, the VCS, we very much rely and count on those kinds of engagements and bringing in those other initiatives. And that's how we started with the methodologies like the CDM, where basically we create the core standard and then we have a process for third parties to come in and propose methodologies. And we used to have just go straight to a methodology concept, and it could be a tool or a technology that's being proposed, or well, I'll talk about dMRV in a minute. But that gets proposed, and then we vet it against transparent criteria, and then dialogue with that proponent. If they meet those criteria, then that can be developed into a methodology that can be used widely under our standard. So that's how we've always done methodologies. What we're seeing now, because there's so much interest in developing methodologies, a lot of proliferation, there's potential overlaps, gaps, complexity that gets created if you have too many thousands of flowers blooming, is now we're working at the earlier stages with meth developers. So we've introduced a year ago the methodology idea note stage, where the earliest ideas come in. They're posted on our website. So if someone else sees a related idea, they can say, oh, I want to partner, or ours is similar, or let's bring everyone together. So it allows more collaboration from the get-go, because we're reporting on those early meth ideas that are coming in our pipeline. So we work with the partners and third parties on methodology, same with tools, the same with dMRV. So in that case, instead of us building the dMRV system ourselves, we're just creating the standards around that and the infrastructure and the connectivity, and then linking that to basically external third-party platforms so that it can be open sourced. You can allow multiple parties to provide it. We don't have to be the ones that are the bottleneck or trying to figure it out. So that's really how we approach all these things. The same with digital assets, where we'll create the connectivity to the other platforms. So we're working with some of the bigger banks now who want to basically digitalize the assets that are currently on our regular registry. So we'll create, again, the architecture, the rules around that, but rather than us creating our own native tokens, we're more inclined to actually just support others' work on that. Does that answer your question?
Excellent. Well, we are at the top of the hour. So with that, I think we will conclude. But I just want to thank each of the panelists today. And I think in the course of the conversation that you all done a fantastic job at validating the reason why I brought all three of you here together for this discussion, because we heard about the benefits, we heard about some of the challenges as well of each of the areas that you're involved in. But I think really the takeaway for me and hopefully all of you is that it's really, if we look at the future of the carbon markets, we think where it may be going, I think it's really the combination, right? It's not 1 + 1 + 1 = 3. It's much more than that, right? And so we needed to be thinking about it more holistically, about driving those kind of intersections, and really about understanding the various components of the ecosystem, what their particular needs are, and then putting those solutions forth. So thank you for your participation today, and thanks for everyone in the audience and who are viewing online. Thanks a lot.